Cathie Wood walked into a boardroom at AllianceBernstein, the firm that had employed her for 12 years, and pitched an idea that her bosses refused to fund. She wanted to build an ETF focused entirely on disruptive innovation. Genomics, artificial intelligence, robotics, technologies that didn't have earnings yet, technologies that Wall Street's valuation models couldn't even price. They said no. So she did something almost no fund manager at her level had ever done. She walked away from a $5 million salary, borrowed against her home, and launched ARK Invest herself. At 58 years old. What Cathie Wood built in the years that followed, and the single thesis she extracted from decades of watching Wall Street systematically ignore the most important technological shifts in human history, is what this entire video is about. Because that thesis is still how she operates today. It's why she's making a bet that most investors think is either visionary or completely delusional. And it's something you can apply to your own portfolio starting right now. The number at the center of that bet? Cathie loved it. That early exposure to thinking that runs against consensus hardwired something into her brain. For the next 4 decades, she'd chase that same feeling. The moment when data points toward a future that nobody else is pricing in yet. Fast forward to the early 2010s. Cathie is sitting inside AllianceBernstein, watching the human genome sequencing cost collapse from $100 million per genome in 2001 to under $10,000. A 99.99% cost decline in just over a decade. She's reading about CRISPR gene editing. She's watching companies like Illumina build the infrastructure for a biology revolution. And she's watching Wall Street completely ignore all of it, because none of these companies had conventional earnings streams. The reason this matters right now is that the same dynamic is playing out again. Only bigger. The cost to sequence a human genome has now fallen below $200. And the downstream applications of that collapse, in cancer detection, personalized medicine, and gene therapy, are only beginning to hit commercial scale. Cathie's entire framework is built on Wright's law, the principle that for every cumulative doubling of production, costs fall by a consistent percentage. She applied this to DNA sequencing. And what she saw was a cost collapse faster than Moore's law in semiconductors. Her specific bet, Exact Sciences, Exis. ARK began accumulating it aggressively starting around 2019, when its Cologuard colorectal cancer screening test was gaining FDA traction. At the time, traditional analysts couldn't model the addressable market because reimbursement was uncertain and adoption was slow. ARK saw the cost curve. By 2021, Exis had become one of ARK's top holdings, and the position had returned over 200% from their cost basis. Here's how you apply this with a $10,000 portfolio. Instead of buying the hottest stock at peak hype, find companies where the underlying cost of their core technology is still dropping rapidly. That cost curve is the moat. When sequencing hits $100 per genome, and it will, the companies sitting on that infrastructure become toll roads for the entire healthcare industry. Cathie doesn't just bet on genomics. She bets on genomics plus AI. Her thesis is that artificial intelligence doesn't just speed up drug discovery. It fundamentally changes what's discoverable. Traditional pharma spends an average of $2.6 billion in 12 years to bring a single drug to market. AI-powered genomic platforms can compress that timeline to under 3 years. Her conviction vehicle here, Recursion Pharmaceuticals, RXRX. ARK began building a position in RXRX throughout 2022 and 2023. During the brutal ARKK drawdown, when most retail investors were selling everything ARK touched, they saw a company using AI to run over 2 million biological experiments per week. A scale no human team could replicate. That's the convergence bet in action. Retail investor application. Look for the intersection, not the component. Don't just buy an AI company. Don't just buy a biotech. Buy the company that sits at the crossroads of both, because that's where the valuation gap between today's price and tomorrow's reality is widest. Cathie's price targets are built on 5-year discounted cash flow models that assume exponential adoption curves. Her famous $50,000 Tesla price target, laughed at by Wall Street in 2018 when the stock was trading near $50 pre-split, wasn't a fantasy. It was the output of a model that priced in autonomous ride-hailing revenue streams that didn't yet exist on any income statement. Applied to genomics. ARK's published research projects the global genomics market reaching $25 trillion by 2030. That number accounts for multi-cancer early detection, gene therapy, agricultural genomics, and AI-accelerated drug development all converging simultaneously. Today, the total market cap of every publicly traded genomics company combined is under $500 billion. Meaning the market is currently pricing in less than 2% of ARK's projected value creation. For a $10,000 investor, this principle means you don't need to be right about which specific gene therapy company wins. You need to be right about whether the category itself grows from $500 billion to something meaningfully larger. Broad exposure through a basket approach. The way ARK itself operates captures the category without requiring perfect stock selection. But here's the part of Cathie Wood's philosophy that almost nobody talks about. She preaches patience. She builds 5-year models. She tells investors to look through the volatility. But if you actually pull ARK's daily trading disclosures, which she publishes every single day, a level of transparency unmatched in the industry, you'll see something different. She trades constantly. In 2021, during ARKK's peak, ARK was turning over positions at a rate that implied an average holding period closer to 18 months. Not 5 years. She was trimming Tesla at $900 to fund new genomics positions. She was cutting Teladoc at $200, a stock she'd later watch fall below $30. The paradox. Cathie Wood has a 5-year thesis horizon but a much shorter execution horizon. She adjusts positions daily based on new data, new cost curve readings, new regulatory signals, and that creates a structural risk that her framework cannot protect against. The Valley of Despair. Between February 2021 and May 2022, ARKK fell 75%. The 5-year thesis didn't change. But investors who bought at the peak and couldn't stomach the drawdown sold at the bottom, locking in losses the thesis said were temporary. The framework is sound. The human psychology required to survive it is the variable Cathie never fully accounts for. And that's why the greatest risk in ARK's genomics bet isn't whether the technology delivers. It's whether you can hold through the 60% drawdown that almost certainly comes before the 10x return. If Cathie Wood's framework were applied to today's market, it would suggest one very specific action for long-duration growth investors. Increase allocation to early-stage genomics and AI biology convergence plays while the sector is still in its post-2021 trough. Multi-cancer early detection companies like Grail and platforms like Pacific Biosciences, PACB, are trading at fractions of their 2021 valuations, while the underlying cost curves that drive Cathie's thesis have only accelerated. The one-sentence version of everything Cathie Wood has built: be early, stay patient, and trust the cost curve over the consensus. That's it. That's the entire philosophy. And right now, the cost curve on human genomic sequencing is doing exactly what it did in 2014 when she left a $5 million salary to bet on it. But there's one more thing Cathie Wood believes that most people find deeply controversial. Her view on what genomics will ultimately do to the entire health insurance industry. And if she's right, it doesn't just disrupt healthcare stocks. It reshapes the entire economy. Here's what I want to know. Do you think the $25 trillion genomics market is a legitimate 5-year opportunity that Wall Street is systematically underpricing? Or is ARK's model just another case of long-duration storytelling that can't survive contact with real earnings? Drop your take below. If this framework changed how you think about disruptive investing. The next video goes even deeper into a billionaire who built his entire fortune by betting against the consensus at the exact moment everyone else was most certain they were right. That video is already up.